and the supportive role of insurance. My name is Gisele Sirot. I'm from AIG, and I'm pleased to introduce the panel, as well as introduce some of the housekeeping issues and go through the agenda. We have today Olly from Founders Factory. He's the managing director. We have Chris Moore from IBOT, Apollo Syndicate 1971. Darren Payne from the Geneva Association, the director of Evolving Liabilities. And hopefully we also have with us today Carl Gray, director, head of insurance of EMEA at Uber. A couple of quick agenda items. I'll go through the housekeeping so that we can understand how to ask questions and address technical issues as well. Then Darren will introduce the findings of the Geneva Association report, and then we'll lead into the panel discussion, hopefully with everyone there, and we'll reserve some time for audience question and answer with closing remarks to follow after that. So very quickly, as a reminder for Zoom as the platform, here's the handy housekeeping slide to show you that, first of all, we are being recorded. Everyone is muted by default. When we have the Q&A at the end, we will unmute you. If you'd like to ask a question, please use the raise your hand function. And then also please remember to unmute yourself after the Geneva Association does that as well. If you prefer to ask your questions via the Q&A chat function, or excuse me, via the Q&A, if you would prefer to do it in writing, please use the Q&A function. And if there are any technical issues, please use the chat and everyone can see that. Perhaps the technical issue is shared by others as well. So with that, I'll turn it over to Darren. Thank you for hosting this, Darren, and thank you for a great paper. Looking forward to seeing the findings.
Many thanks, Gisele, and hello to everybody else on the panel, as well as those people dialing in or viewing online. Can we go to slide 7, please? So the digital entrepreneurship and supportive role of insurance. This is the report that we released back at the end of September. And we're now doing this webinar to kind of publicize some of the results and findings of the report. I'm in the next 10 minutes or so going to kind of try and summarize the key findings, but I'm not going to do a great job of getting everything in. So I'd encourage you, if you're interested in the topic, to visit the Geneva Association website, and you can download a full copy of the report together with a research brief which summarizes it probably better than I can do in 10 minutes. Next slide, please. So digital entrepreneurship, it's a somewhat slippery concept. When I was kind of starting out, part of the issue was trying to define what it meant. I mean, at face value, it seems pretty straightforward. It's got something to do with entrepreneurs, i.e. new business formation and new technology, especially the shift towards the use of platforms or to conduct trade or commerce. But not all entrepreneurs develop digital tools, and not all users and developers of digital technology are entrepreneurs. So to try and get at this sort of slight conundrum and the definitional issue, what this slide tries to do is to separate the 3 core constituents in the overall sharing or gig economy. The workers or the self-employed contractors who offer traditional labor services, the traditional entrepreneurs who might, for example, sell their products and services online and then create the purpose of collating this together under this through Venn diagram is to isolate those core elements or core participants or actors that we call digital entrepreneurs. And they can be largely divided into 3 camps. There's owners of digital platforms, by which I mean both new and established platforms. Tech startups or app developers, they're firms that produce new hardware or software for computers or mobile devices, often distributed through platforms. And then there's a whole section of intrapreneurs. These are employees of existing firms who are developing digital innovations within existing organizations. For example, new platform business models that incumbent firms may well be designing. So these are the three core actors that we try and delve in a little bit more in the rest of the report about. Next slide, please. As well as the sort of definitional issue, measuring digital entrepreneurship is also not especially straightforward. It relies on some indirect measures. And what I've collated together here on the left-hand side is a radar diagram that summarizes an index of digital entrepreneurship that's put together by the Global Entrepreneurship Institute, where they collate together and create indices of what they call digital entrepreneurs and digital entrepreneurship or platformization. And you can see there's quite a lot of large variation across countries. North America is particularly ranks highly. The lowest levels are in parts of Africa. And in some ways that gives you a clue to what the next question will be, is how far this difference in countries reflects the stage of economic development. And the chart on the right tries to get at that question by plotting the scores for digital entrepreneurship against the GDP per capita as a proxy for economic development. And you can see that there's quite a close positive correlation between the digital entrepreneurship and GDP per capita. And the reasons for that are likely to be complex, but it's probably likely to do something to do with the sort of financial, physical, educational infrastructure that you develop as you become wealthier as a country. So given that relationship, how can we see which countries are particularly outliers relative to others? And what we try to do here is plot a trend line through that right-hand chart to try and control for the stage of development of a country. And there's a number of things that stand out. The US has the highest score above the trend line, as are Canada, the UK, Netherlands, and Sweden. But among the emerging economies, India, Ukraine, Malaysia, and Estonia also are positive outliers. In contrast, the number of European countries among the advanced set of countries too, as well as the relatively rich Asian countries, underperform relative to the size of their economies, which is an interesting aspect of the rate of diffusion of digital entrepreneurship. That said, country level indicators probably don't give you the full extent of digital entrepreneurship across countries. Within the individual countries, their local startup communities and ecosystems are often critical in catalyzing technology and innovation. And indeed, when you look at the city level, you can see a number of Asia Pacific cities have really moved up the league tables of startup hubs. In particular, Beijing and Shanghai have really become much more prevalent within the top ecosystems for startup, suggesting that there is something also going on even within the sort of country, regions where digital entrepreneurship is not especially prolific. In some conurbations, some cities and regions, it's particularly active. Next slide, please. Having defined what the actors are and where they operate, next important aspect is trying to appreciate how digital entrepreneurs create economic value. Traditionally, a firm generated economic value by deploying physical capital, stocks, buildings, machinery and equipment, together with labor. Today, firms, particularly digital firms, the value they create is much more related to intangibles, knowledge-based assets, such as reputation, human capital, and intellectual property. However, from an insurance perspective, the factors that influence the value of those intangibles are complex and not always fully understood. Importantly, too, those intangibles reflect not only those that boost the value of the firm, but also one's contingent liabilities that might undermine its net wealth. For example, a loss of reputation or unsafe working conditions or products that injure employees or customers and lead to possible legal claims. They're just, all of those intangible risks are just difficult to quantify, but ultimately could be really important for the viability of a firm. Just to put some more flesh on the bones, what are the sort of risks we're talking about here? Obvious ones are cyber and privacy breaches. Digital firms rely heavily on the information assets together with the access to IT. So cybersecurity and privacy breaches are clearly an important factor. But it's not only that, sort of IP protection and infringements, also indirect liability for torts of third parties that use their platforms, by which I mean both the users, but also maybe third-party suppliers that are servicing customers via the platform. Likewise, reputational harm. That can be both a source of worry for your own reputation, but also potentially you can create reputational damage to other parties, giving rise to a third-party claim. Next slide, please. So given that background, where does insurance fit in? I said that these risks are quite difficult to quantify and measure. When you look at the anatomy or a post-mortem of startup failure, some of these risks currently, they don't feature heavily in the reasons for why a startup was closed. Most of the time, a startup in particular will fail because of lack of market fit or product fit, or also just general marketing problems. But you'll see from this green slither of 2% that there are some read across to liability insurance being a potential important backstop against catastrophic claims. And against that backdrop, and what I said about the role of intangible risks becoming more important, it is a little bit surprising, and maybe this will come out a little bit in the discussion, that when you think about it from the take-up of insurance, small firms in particular, of which I'm not exclusively talking about startups, could be established small firms that are not necessarily digital startups, they tend to be Many don't have insurance, and more than a third of businesses experience an event that could have led to insurance claims. Next slide, please. So against that backdrop, I want to kind of put a little bit of a manifesto down about how insurance can do better to support those digital entrepreneurs. And we've divided the overall message is, I think, that a portfolio of innovation by insurers will best support those new budding digital companies. If we start in the bottom right-hand corner, to some extent, just as an element of marketing, insurance is better. It will be helpful. A lot of the time, in entrepreneurs, particularly those startups who might not have much connection with the insurance sector, might be unaware of the risks they're running and the role that insurance can play to protect themselves. For their part, insurers can do much better at simplifying policy wordings and potentially employing specialist staff who better understand the needs of digital firms. Moving clockwise, I think process innovation is also part of the story. I think insurers can learn and partner with insurtechs to improve the distribution and their underwriting capacity towards fledgling companies. Often the case, particularly with intangible risks, traditional underwriting models don't necessarily work, not least because of the nature of the data you need to assess the underlying risks. So part of that process innovation may also involve collaborating with digital entrepreneurs by insurers to better understand and calibrate some of the risks that they're facing. Moving up, product innovation. I think that's one where I think that there's quite a lot more could be done. And I'm highlighting two elements here. I think parametric insurance, as opposed to the pure indemnity product that's typically been in insurance, is something that could be explored in more detail for some of these digital entrepreneurs. I've given some examples here. Reputation risk protection. Also, there's a new stream of insurance-backed guarantees for AI software, which guarantees the performance of some of the software. Also, business interruption covers that may well be available based on parametric design for outage or IT disruptions. And then finally, I think all of the marketing process and product innovation are good up to a point, but I think where more could be done from the insurance sector needs to be its own, look to itself a little bit and reorganize itself to better kind of service some of the digital entrepreneur community. And I've highlighted the role of the application program interface architecture, a so-called API. That's kind of ubiquitous in the new digital business models. I think insurers have thus far only dipped their toe in the water. I think they can do more to integrate that API architecture. But more than that, I think they can go towards where potentially, and this is controversial, which may come out in the discussion, maybe more moves towards more open APIs, which encourage embedding insurance more directly in the ecosystem that some of these digital entrepreneurs and digital firms operate. There's like to be trade-offs with that. Insurers worry about giving up some of that information, but maybe some of their information that they have about their kind of customers will be augmented by expertise that they can get from business partners within the broader ecosystem. But let me stop there and say this is the overall message is that some of it is to do with better marketing, but I think a whole innovation by insurance can better meet the needs of digital entrepreneurs. Thank you. Back to Gisele.
Thank you very much, Darren, for that overview. That was really terrific and a good jumping off point. Like the paper says in its title, we are sort of presuming that insurance has a supportive role. And for those who are already in insurance, this might be quite evident. But Chris, Olly, maybe we could start with you and you could give your thoughts on how it is that this supportive role exists and what's changed through digitization.
Sure, I'm happy to kick off with that. Thank you. I think if you look at a traditional setting of how insurance has been positioned, it's been very much a product by necessity in a lot of cases. You see a lot of companies will buy insurance because it's balance sheet protection. It's something that they've been required to for a stakeholder or regulatory purchase, or it's a contractual requirement. And so from that position, it's not necessarily a strategic purchase. It's a very important one, but not strategic. And I think the transition that is being mandated for us as an industry with innovation and digital entrepreneurship is we need to shift this supplier-buyer model where someone needs to buy insurance and I'm going to go buy a product off the shelf to one of strategic co-collaboration and partnership. These innovative risks by design need an innovative solution. And what they're looking for is a solution that's fit for purpose. And rather than just for that balance sheet protection, what these new wave of buyers are looking for is an insurance product that is going to allow them to build trust because it's a new form of product, it's a new form of service. We've seen that in the sharing economy. Are you going to get in a stranger's car unless you think there's risk management insurance in place? Probably not. Are you going to put your home on an accommodation sharing platform unless you think there's insurance that if something goes wrong, that damage is going to be paid for? So then it becomes about, like I say, building trust. And if you can build that trust with an insurance product, that can enable your platform to grow because more people are going to interact with your services and your platform. So it's completely shifting what insurance does for a company. And I think if we can get that and understand that correctly, there's a massive opportunity for collaboration to drive the industry forward.
You've touched on a lot of points, Chris, that I'd really like to come back to in detail.
Sure.
Some of the other questions. And Olly, I had directed the question to you at first, but if you think it would be fair to let Carl respond and maybe say yes, whether he agrees with Chris's view of that collaboration, if there's anything to add, and particularly address those digitization points and how that has changed insurance's role within the ecosystem.
Yes, I guess I would agree with pretty much everything Chris just said. I think the relationship needs to move away from one which is primarily based on a product or a commodity which an insurer can sell to the platform or to the entrepreneur, to something that is a strategic partnership. And the reason for that is maybe maybe it's obvious, maybe it isn't obvious, but a lot of the activity that an entrepreneur is undertaking is almost by definition quite new. So they're taking on new types of risks. They're quite often distributing products, or they're requesting a product be distributed to them in a way that traditionally hasn't been done. So I think many of the traditional approaches of insurers, and not just the product or the product cover, but the entire life cycle of how a product is produced and how it's priced, how it's underwritten, the after service in terms of claim support, re-underwriting, performance management of the risk, a lot of that, and the risk management, a lot of it, so pretty much everything, I guess, needs to change in a way that becomes strategic and no longer a tactical, commodified product that is being provided. Now, the good news is that sounds perhaps overwhelming, but the good news is that the digital environment actually allows all of that to happen pretty easily. In fact, arguably, it's easier to produce a product that is fully connected and digitized and is flexible than it is to offer a static product using traditional methods. So I think a lot of what Chris was talking about is correct, and I think a lot of it can be achieved. The bit I would add is a lot of it can be achieved through connectivity and through digitization and through some of the methods and topics that Darren was mentioning earlier.
Thanks, Carl. Olly, you sort of see the trajectory of the digital entrepreneurs. You see that there are other players in the ecosystem who aren't, just the startups. You see the entrepreneurs as well. How do you see the difference in the insurance needs of those different types of actors that the Geneva Association describes?
Yeah, and I think it's interesting. I think to provide the right insurance product or any product, obviously you've got to get into the mindset of your customer. And so if we take a tech startup entrepreneur or founder, then the mindset's quite different. I think it's interesting that really, so tech startups is really an experiment to see if you can scale your idea and your business at terrific scale and enough scale to survive. And so actually, as a tech startup, you'll tend to take, let's say, mandatory insurances that you need to start generating revenue, employers' liability and policies and protections like that. But actually beyond that, you'll tend to self-insure. So the mindset of a founder or a tech startup entrepreneur is to self-insure, because really what you're doing is you're looking to reach that exit velocity to prove that you're going to survive. And you'll tend to self-insure because actually your risk of failure is kind of binary and macro driven. So, can insurance really protect against you trying to solve a problem for customers that doesn't actually exist, like just having the wrong product or having a product you built that doesn't actually solve a problem, or not raising enough capital to actually get your business to any kind of scale, or falling out with your co-founder or giving up on the idea. So I think it's really a challenge around how insurance companies and providers can adapt to try and support that kind of early stage part of the journey for a tech startup. I mean, when a tech startup's got to enough scale to survive and be, past that exit velocity, then they do start to look like traditional businesses. They have revenues, they have balance sheets, they have employees, and they probably move to look a little bit more traditional. But before that, really the risks you're trying to mitigate against are very different. And so I think there's this kind of both Carl and other people have talked about, Chris as well, around kind of collaboration. I guess for me, it's about the problem at the moment is kind of a data dislocation between an understanding. How can an insurance company possibly understand a startup who hasn't quite figured out yet what they are as a company? They don't have revenues necessarily. They have IP. Potentially they're building IP. Potentially, yes, one of the risks is they need to protect their brand or reputation. Yeah, it's a real interesting challenge. I think the answer is in connectivity that Carl mentioned, collaboration that Chris mentioned, closing that data gap. How you do it, not quite sure. I'm trying to solve some of these problems myself. How do you insure against founders falling out with each other? I don't think you can insure against, building the wrong product that doesn't solve a problem. And so it's probably trying to pick the stage in a startup's journey or a tech startup's journey where you do move beyond self-insurance. Because I think for the early stage, you do self-insure. Because I guess just back to that point, just because everything's so binary, it's either going to work or it's not. The last thing I want to do is get distracted trying to buy some insurance, because something massive could happen tomorrow that means I just don't exist.
Yeah, that's really interesting. Go ahead, Darren. Sorry.
Can I just underscore that in the sense, even though I think that insurers could do more on the whole portfolio of innovation, I think, and this is where I've got my kind of insurance hat on, which is there are fundamentally some risks that go beyond the perimeter of insurability. And I think they're most obvious within sort of business risks that might either be sort of unquantifiable or not diversifiable by an insurer. But the point I try and make in the report is that perimeter or that boundary of insurability can itself migrate and move over time. And to Olly's point and Chris's point and Carl's point, which is that some of the data that we may well be capturing, or the information, maybe even some of the collaboration with the entrepreneurs themselves, can help move that boundary of insurability alongside some sort of risk expertise by the insurers to kind of better get a handle on some of those risks. But there will be fundamentally some risks, business risks in particular, that stray outside of any legitimate risk appetite of insurance.
I just wanted to jump in on some touch on that point that Ollie was making about that self-insurance, and it comes through in the report about how we market insurance. I think it's a classic that insurers will say, "Hey, we're here for that disaster scenario." Insurance does a huge amount more than just insure catastrophe type losses. And actually, that data gap that you were talking about is hugely relevant. With digital entrepreneurs, specifically in the sharing economy, and Carl, in his Uber world, they have huge amounts of data on that auto risk that would far outweigh a lot of insurers' insights into auto risks, right? They have, live telematics in many cases. They'll know exactly where things are being driven, how they're being driven, when they're being driven. They have so much view on peer ratings, all these different things. If insurers will truly collaborate and willing to innovate internally, so they accept that data, they trust that data, even though it doesn't have your 10, 15, 20 years of developed loss claims data to support the exposure data, you can actually get huge granular insights into risk management, but also that can lead into profitability. So you can actually say, okay, if this is my whole spectrum of my exposures, I can now really drill down and say, this element, this 10% of my exposures is where I have the lowest insurance risk. So I'm maximizing profitability. And then this is the element of 10% of my exposures where my insurance risk is so high, it's impossible for me to be profitable here. So when you think about that, and when insurance can start unlocking a lot of capabilities to maximize and optimize the business model, it's just as insurers, we're terrible at marketing that sort of ability. And often, we have been guilty of not being willing to innovate and to embrace new data sources and collaborate and partner. Truly, we say partnership a lot, but I sometimes think we're a bit guilty of failing in that regard. So I just wanted to... My defense of the insurance industry is there's a lot more we can give, I suppose.
I think it's a good point. I mean, if you look at the bulk of claims that an insurer would pay, they would be attritional losses. They would not be cat losses and large losses. And the risk management part that you referenced, I think many of the big platforms, whether it's Uber or anyone else, by definition, have a lot of data available. And that means that they can risk manage the subject matter of a risk in a way that traditional businesses simply can't. They will use the example of motor insurance or motor risks. You do have many platforms by default will have a lot of information on how the vehicle's been driven and where it's being driven, potentially subject to data privacy rules and so on and so forth, which is another discussion. But at least conceptually, there is a lot of information on the risk that can't be used just to share with the insurer to improve the pricing of the risk, but can be used simply to risk manage whatever the service or good that the platform is providing. And that's critical for insurers. Quite often you hear the term that ride hailing or ride sharing is simply taxis on an app. But actually the big difference is that you do have the ability to very strongly risk manage vehicles that have been on some of the big platforms such as Uber in a way that you couldn't do with traditional taxis. So they're actually, although the conventional view is that they may be a worse risk, they're actually a much better risk for that single reason, I think.
It's very interesting because when we were talking about the data disconnect, it seemed that there was also a bit of a perception disconnect in terms of how insurance sees its role and how, say, startups see their role. And Carl, it's great to hear from you because Uber's had that entire trajectory going from the startup to what is it that I'm supposed to insure to now I'm in a position to really be able to manage a certain degree of risk. But I would turn the question back to Olly and just say, well, you know, what is that early perception gap? What is it? Is it an idea of catastrophic losses that should be insured, and that's what insurance is there for? And that's not what startups are thinking when they're first starting out in terms of their insurance needs. How would you say, you know, taking a few steps back from the startup that isn't at Uber's position just yet?
Yeah, I think, and it's worth kind of, separating entrepreneurs who are individuals and kind of small businesses versus tech startup entrepreneurs. Main difference is tech startup entrepreneurs, like the people that started Uber, wanted to change the world, and reach terrific scale. And an entrepreneur, Uber rider or driver, probably wants flexibility, financial security. They don't have different levels of ambition, just maybe the goal is slightly different. So for a tech entrepreneur starting a business to change the world, well, the perception is nothing's more important in the early stages than making sure I'm building a product that actually solves a problem for a terrific amount of people, and a problem they encounter a lot of the time, and it hurts, right? That's like the first part. I've got to solve a real problem. Then I've got to reach those customers at viable economics such that I can actually scale and be sustainable. And therefore, basically, the mindset is I've just got loads more important things to do. So I don't have time to I don't even have bandwidth to listen to an insurance company propose how they could help me on that journey and how they could kind of mitigate some of the risks along my journey. Because the way I'm mitigating the risks, it's not just self-insuring in the kind of sense of it's not even consciously making a decision to opt out of insurance and take the risk yourself. It's just you've got more important things to do, which is the bigger risk, like I say, is it's not a catastrophic risk in the sense of an existential risk that I didn't know about. It's just that I fail. And so it's a totally different mindset. So I think the challenge for insurers is, like say, sort of when on that journey, insurance really can make a difference and really can take some pressure off the startup. So it could be when you've when you have got to a product that works, then how do you protect, your IP from being devalued from kind of competitor disruption, let's say, or some way of kind of protecting. Maybe the main one's kind of some kind of cyber threat. We're talking about tech startups with the consequence of reputational risk. I think it's kind of how can you engage with the startup early enough to build the data, the context, and the understanding to ever be front of mind when it comes to even thinking about, well, now's probably the time that I could use insurance as a mechanism to accelerate growth.
When you said the magic words, and before I get to the question, however, we can maybe just remind the audience that if you do have questions, please feel free to type them in the Q&A. But the magic words were reputational risk. And I think that's a really interesting area to start. One, because Darren mentioned that both in the overview and in a number of places in the report itself. And that's probably something that's front of mind, both for the individuals, the startups themselves, and then platforms that are very well developed, because the ongoing activity also depends on how much trust it continues to reside within the platforms themselves. So Chris, maybe you could help us on this subject and jump in with your thoughts on, do you think that there is a disconnect in terms of like the role that reputation plays and how it is that it can be protected from the view of the digital entrepreneur and from the view of the insurer?
Yeah, absolutely. I think, again, with digital platforms, especially if they're in that innovative, disruptive is a term that some people use space. I think trust is everything. And if you don't trust the platform, you're unlikely to engage with it, and growth is going to be pretty stagnant. So you're seeing a lot of the times insurance positioned for that trust element. But then it comes down to the insurance product, doing what it's designed to do, which is to pay claims, right? And in that setting, that's where trust and brand reputation is absolutely key. And I think what's really interesting in what we're starting to see in the new wave of startups or some of the more established platforms is how they're actually now positioning insurance as one of their unique selling points. So whilst in a true startup, and I completely agree with Olly, when they're in real startup mode, the first 12, 18, 24 months of their life cycle, absolutely, I'm sure insurance is for them as a platform, not on the key important task that we have to nail. But when you start getting to more established platforms, positioning insurance to enable growth can be something that's really impactful. You take examples like the ride-sharing setting, where they are competing with other, Uber competing with Lyft, or competing with a company like Bolt or Via, depending on the territory you're in. How do I attract that product, which is a driver? And, you saw the insurance solution being, well, let's buy an occupational accident type insurance solution that gives the driver benefits that makes them more likely to drive for us than a competitor. That's quite, again, another unique position for insurance, that you can attract more drivers to their platform to grow their platform from an insurance purchase. So I think that sort of thing, adds reputation. It builds more trust with regulators as well as the driver community. So I think that's quite interesting. I think you'll see a lot more distribution of insurance products like that through platforms. But in terms of that reputational risk as a platform, in terms of brand damage or financial implications, I do think the insurance industry has listened to that as one of the biggest emerging risks, especially as companies become more digital. And I think Lloyd's has done some great innovation there within certain syndicates. With creating parametric type insurance products where you list out a number of events and scenarios where the insurance will trigger, and there's a financial sort of payout for a valid claim linked to reputational risk. So I do think there's a lot more innovation that can happen in that space, but I do think it's happening. But across the whole spectrum, I think insurance is changing the way it's positioned to build more trust, to protect the platform's reputation, because more people, I'm sure if there was a poll done of who do you trust more, Airbnb or an insurance company, I probably wouldn't put a big bet on the insurance company winning. And so maybe it's better to distribute our products through a platform like that at point of sale with a great customer experience, rather than trying to sell our own product. So I think, that sort of collaboration is definitely the future of how I see embedded insurance and insurance distribution.
Thanks, Chris. You raise a lot of interesting points in that response as well. And one of them, going back to Darren's finishing point, which was that there's a lot of room to do better. The problem, quote unquote, is that it isn't static. As insurance is catching up, as there's more innovation to address the evolving needs of these platforms, the platforms themselves are also evolving in a different world. And so I think, since we have the benefit of Carl's presence here, maybe you could tell us, Carl, about how transportation as a service is evolving. And in the framework of trust and reputation, what is it that is changing in terms of those insurance needs from what has now been much more accepted in the ride-sharing world?
Gosh, I mean, in terms of how transportation is changing, that is pretty profound, of course, and it's been happening for some time now. It's not completely new, but we're seeing a move away from traditional private ownership of vehicles to a form of shared ownership in some circumstances. We're seeing vehicles move from being used as for single trips to being used in a form of ride hailing. So you have ride sharing, you have ride hailing, you have a move from traditional forms of carbon fuel propulsion to electric. Of course, that's pretty substantial as well. You're seeing the sort of historical promise of integrated transport systems beginning to happen. So the ability to use ride hailing for part of your trip, and then perhaps to use some type of metro train, and then some type of bus, and of course, some type of bicycle as well. So we're seeing a lot of different trends, I think, all happening at once. I think digitization and COVID have probably pushed that forward even more aggressively. So we're now seeing signs that people are using ride hailing perhaps more than they've ever used. I think many of the big platforms, including Uber, it's no secret that they are seeing tremendous demand in terms of number of trips. And if anything, there is a shortage in terms of number of drivers available. So I think in terms of how transportation's moving, a lot of the trends have been there for some time, but we're now seeing them trends come to the fore more than ever. There's some sort of new twist happening as well because of COVID. There's arguably a reduction in the use of public transport because of a perceived risk of infection to the use of ride hailing. People feel safer in an individual vehicle sitting by themselves with a driver rather than being part of a large train carriage or perhaps a bus. That trend is a bit unclear, but there's some evidence that it might be true. So I think we're seeing a lot of that happen, and insurance needs, it goes back to the point that I was making at the beginning, that the traditional products offered by an insurer, where perhaps they would have had a product for a private vehicle and then maybe a product for a taxi, they would have had fleet solutions for commercial rental fleets, very specific specialized solutions for public transport. We're definitely seeing a move away from them type of traditional products to products that are perhaps moving towards insuring the individual, whether that individual is using an individual vehicle or whether they're using public transport or anything in between. So there are some companies that are beginning to produce them type of individual personal mobility insurances. There still aren't too many out there, but there's a few. In terms of the individual platforms, I think the trust question is a big one. I mean, interestingly, the insurance brands, I take the point that was made that insurance brands perhaps are not as trusted as much as platform brands, but they do normally score much higher in terms of financial stability and financial solvency. So actually the insurance brands can sometimes add something to the platform brand by bringing that degree of solvency and financial security. And certainly when you're talking about insurance, it probably does add some value when you have a big branded name next to a platform name, stressing that the insurance is being provided by that brand. So I think the trust question, at least in relation to brand, I think there is a big place for insurers to play there.
Completely agree. I just want to add on that, Carl. I think what we might see is, rather than platforms, and it's my biggest fear as an insurer that platforms, buy more and more self-insurance, and the words of Elon Musk and Tesla and their approach becomes more common. I do hope not. But I see large sharing economy platforms certainly as the biggest growth in terms of a distribution for insurers. So maybe it's cover holder status, that sort of thing, where those platforms are administering insurance policies on our capital base, on our paper, to their users, to their marketplace. Like I say, to create that trust, create a better user experience, and by utilizing all the data you have on those individuals in the marketplace that we don't have, and so we can price it a lot quicker, ask a lot more questions, just make the whole customer journey a lot better.
In terms of distribution, I completely agree with you. I think the future, I think it's been obvious for some time, but the future distribution of insurance products, by definition, will be, the point of purchase will be where people are buying products and services, and they're, broadly speaking, not on insurance websites anymore. They'll be on the big platforms.
Completely agree.
Just wanted to turn very quickly to the question of distribution for a moment, because I think there's a couple of interesting things that are happening. Probably those who have been around insurance for a while know that one can either insure the platform itself and any sort of contingent risks that bubble up to it, that would bubble up to it, or there's also the individual providers, quote unquote, on any type of platform who could also be insured. And potentially, if the users or the end customers are willing to do so, they can also purchase insurance for themselves. And in a sense, it would follow that decentralized liability or this distribution, as the contracts that underlie the platforms would say, that's something that follows. But there's a couple of trends in a couple of jurisdictions, and the US is certainly one of them, where we can't quite seem to get away from the centralized notion. And that is that because you log into one portal or platform, and because the payment processing is done by the single platform, that maybe that's exactly where the liability should arise. Do you think there's something that can be done or should be done to counter that? Or do you think that decentralized liability is something that must be pushed for in order to sort of keep the platform model vibrant?
It's a fantastic question, one that we could spend a whole hour speaking about. I think there are a lot of benefits to the actual centralized liability platform sort of approach if done well, because when you talk about the US setting where that is very much the case, platforms extending insurance on behalf of either drivers or service contractors or whatever the platform does, right, providing that element of insurance. It does make for a fantastic user experience, because that person doesn't have to go and buy their own insurance and source their own insurance and go through what is a painful customer experience. That's changing, I'd like to think, but it's a lot better for the individuals engaging with that platform. And again, that can make it a USP if you're a centralized model versus a competitor that's decentralized, where you have to bring your own insurance. And with the amount of data that those platforms will have, I think there's an ability to remove some volatility and price that risk very accurately. Us within my team at Apollo, we have a huge amount of data scientists and actuaries because of the amount of data we get from platforms and looking for those risk insights to better price risk and manage risk. When you look at the alternative, which you see a lot more in the European model of that decentralized liability, then you have a really fragmented insurance distribution. So you'll have a platform that might have drivers that will buy from all different types of insurance companies, and the coverage is very different. And so you have still an element of that contingent liability, and you have a risk that the insurance will fail or is not fit for purpose. So that can lead to underinsurance or a lack of insurance completely. So I suppose there are pitfalls in both models, but if done well, I don't see why a centralized liability stance would be would prevent a platform being successful. Certainly, it would mean that they spend more on insurance, of course, but hopefully they can account for that sort of cost within the cost of their services. So I do think it can be done well, but it's very much a regulatory position, and I certainly think that with the centralized liability, there should be more comprehensive coverage across. That there's going to be insurance for every type of incident, whereas decentralized, there will be coverage gaps. So it's a very tough one.
I think one of the things with this, it is a great question. I think for me, it should be driven by end user or the entity demand, right? So whether that's an individual rider or whether that's a platform or a provider. And so I think I tend to agree with Chris. I think it's interesting. My prediction would be it will go in a few phases. So the centralized model, there's a load of opportunity to be unlocked. Within embedded insurance, I'd say we're very much on version 1, which is, Carl said it, distribute at point of purchase or point of problem. Just makes sense. It will drive higher adoption. Version 2 for me then becomes actually using the data Chris talked about, and Carl mentioned interconnectivity or connectivity earlier. If you centralize the model and use the data properly and use all the data available in the context, you should be able to protect people and provide the right protection and better protection across those end users. I suppose potentially the challenge, or the version 2 to version 3 is there enough price competitiveness to make sure that the protection being provided is relevant and good value? And I suppose the slight challenge to the truly centralized model could be potentially lack of value or lack of competition on price. So then do you find that actually there's a bit of a hybrid? Use the centralization for brilliant protection of the right product distributed elegantly to end user, and then use decentralization in some way to bring value and competition to the pricing.
I suppose you add. Oh, go on, Carl, please.
I was just going to add that I agree with everything you said, but there is, and kind of you touched on it, I think, Ollie, but there is the hybrid solution where you have some of it centralized, some of it decentralized, and there is there are some products now being developed where the platform itself will perhaps purchase the bulk of the coverage for the people using the platform, but then you have optional coverages where the individuals using the platform, either as a service provider or as a user, could potentially add additional optional coverage onto that sort of central coverage. So it's not something that's straightforward for insurers to do, and I think some of them raise their eyebrows when they're looking at it. But it goes back to what we were saying originally. It is something that is desirable, I think, ultimately, to have that degree of flexibility, and connectivity and digitization actually allows you to do it, notwithstanding any regulatory issues, in a fairly straightforward manner, I would argue.
I was just going to add that a lot of the challenges with the decentralized model are the lack of flexibility and products available within the insurance sector, unfortunately, because as a classic millennial, you don't have people that just engage with one platform. And if ever the pandemic has shown us anything, it's a lot of insurance products, when delivered to an individual consumer, so more personal lines, are not usage-based. And so when you have the centralized model, you're normally the insurance works that will cover you when you're on app. Off app is nothing really to do with us, right? When you've got the decentralized model, I've got a product that I might say, hey, I'm going to drive for this platform, and then you don't drive this platform, but you've paid this annual premium and you don't really get the product you deserve, right? So someone gets a bit of a sour taste. And if you're then saying, well, I do a bit of delivery and then I put my home on an accommodation sharing platform, I do a bit of ride sharing, I also use e-scooters, and I do a bit of freelance photography work on a platform, there's no insurance product in the world that's going to cover you for all those. And I feel sorry for the poor person that's going to have to buy 5 different policies, because that's a very different user experience. So a lot of that is on the insurance industry.
No, absolutely. And it references again you're correct that it doesn't exist, but that, and you'll be aware of this, I'm sure, Chris, there's been some attempts to build these personal mobility type products where you do try and do that you give the individual a product that will cover them in all the scenarios you just met. But I don't think anyone's really managed to do it yet that I'm aware of. So it is difficult, but that's probably the future, I think.
But I'd love that concept, if that does happen, of having an ability to utilize the data available. So, taking like a credit score type concept into a trust score, because if someone has got a great, ratings on an accommodation sharing platform, they have great ratings on a ride share platform, that's an indicator of a trustful person, a good risk. I think the data usage, if that does happen, would be fantastic.
And I think, again, there's been some experimental analysis going on in that space. And I think things like the TripAdvisor scorings, customer service scorings, definitely do have some bearing on the risk. It's sometimes not as straightforward. It's not straightforward to understand why there's a correlation between them and the risk, but they're often, my understanding is there often is. And certainly with Uber, I can speak with some confidence that the score that the passenger gives the driver is actually very heavily correlated to accident frequency. Maybe that's obvious why, maybe it isn't, but we tend to find that there is some evidence of that in many markets we operate in.
And then again, that is another challenge to the insurance industry is with the way that we are set up in many organizations, be able to trust that, right? Because we're not going to have the data to support what you're telling us, right? That's partnership, trust with the insured. I mean, we do a lot of insurance in the micro-mobility, so to e-scooters, and it would be easy to just say, right, classic rating factor for many insurance policies using age. Well, who would you prefer to insure? Would you insure a 50, 60-year-old person on an e-scooter, or a 24-year-old that's probably used two-wheel devices a lot in their history, right? So age all of a sudden doesn't really work for that model. So it's kind of getting out of our own way as an industry and saying we can't always rely on the things that we have done for the last 30, 50 years, because the world is very different today.
Yeah.
Can I just ask a question about that in terms of the decentralized? I just wonder if the decentralized model is completely viable, given where Gisele started off, which was saying that the sort of legislators and regulators are trying to, well, essentially push some of the risk back onto the platforms, i.e. the liability risk. And you can't, it doesn't obviate the need to kind of compensate victims. So I just wonder if that's another reason why you might get a hybrid model, but you won't get fundamentally to the fully decentralized model, precisely because fundamentally some of this liability can't be got rid of from the platform, not least because, secondly, some of the control that the platforms exercise over some of their workers, users, suppliers.
I think it's a good observation, Darren, that so everyone today has talked about insurers kind of needing to up their game. Probably, I think if we went to a fully decentralized individual level insurance, so me getting protection for whatever platforms I use, right? The data exists. If I am willing to share it, then I'm sure that Chris could effectively underwrite me for whatever I do in my life. The challenge might be regulation needs to fall into line as well. So I think that, without getting too philosophical about it, regulation is centralized by definition at the moment. And so you probably do need to end up with a hybrid or a transitional model, because regulation is going to say platforms have to carry central liabilities, or there's certain rules and regulations for which scooters I can get on in Nottingham in the city. I can't get my own scooter. I have to use a scooter they provide. I can only ride it in certain ways in certain places. So actually true decentralization without regulation adapting, I think, is difficult, because regulators are centralized.
And I think also the legal system, certainly what we've seen in the United States with, social inflation, deep pockets type scenarios, social inflation now starting to become prevalent in other countries and regions outside the US. I don't think we're going to get to a stage where the platform won't be named in lawsuits, won't be brought into things, won't have some form of liability put on them. Whether that's right or wrong, obviously, is not what I'm trying to discuss. But I do think there's always going to be the need of the platform to protect themselves because of that. Yeah, certainly in the United States particularly, but also in Australia, sometimes you do get those nuclear verdicts that don't seem to follow rationale or fair outcomes. But it's just the big bad world of tech and the bad reputation that some of them have, and how those plaintiffs paint that picture in a court of law.
And we still have the issue of insurable interest. That hasn't really been sorted out in many legal regimes and regulatory regimes. So it's still, there's this kind of paradox that the platform should be liable, but then at the same time, they may not have no insurable interest for the service or the provider of the service. So it's difficult for the insurer to provide insurance to a platform that doesn't have a direct insurable interest, at least, in the service being provided. And just so I'm being clear there, so if you take Uber for an example, you have someone who's a self-employed individual, at least outside of the UK, to make it simpler given the redefinition there, but you have someone who's a self-employed individual in their own private individual vehicle, using it to carry passengers through the platform. It wouldn't, in most markets, would not be straightforward for Uber to purchase, or a platform in that position to purchase a motor risk insurance policy for that driver, because they don't employ the driver, and two, they don't own the vehicle. So it is the insurable interest, I think, it's always been the issue from the beginning, and I think it's improved, but it's improved in terms of its interpretation by the regulators and the insurers, but it is still definitely an issue in many areas.
Well, Chris, I think you called it when you said this was a subject unto itself and that it could go on for an hour. And I'm loath to interrupt the conversation because it is a very interesting one. But I am sensitive to the fact that we have scheduled a Q&A period and would like to give the audience the opportunity to ask some questions. And if anyone wants to kick it off, raising their hand. And if not, we can go to some of the written questions that have come in. Okay, well, let's kick it off with the written first. We've spoken a lot about platforms and the sharing economy. We have a question that raises such a magic word. Well, actually, the first one, it was reputation risk. And someone has asked whether how parametric protection would work in the context of reputation risk.
Maybe I can take that and ask Chris maybe to add some color. I mean, fundamentally, reputation risks are sometimes covered within conventional insurance policies, liability, property type of risks. But I think the new genre of reputation products, particularly on the parametric side, are trying to better measure the impact of the reputational loss according to the impressions by stakeholders. So there's an element of trying to measure the reputational damage, and there's a number of outfits. I'll spare them the advert on this broadcast, but there's a number of outfits that have developed bespoke indices that trying to measure reputation across particular firms, and then if you can then assess to what extent a particular event has reduced that index, you can then write contracts on the basis of how far that's been impacted, and therefore write compensation rules that may well flow to the insured from that. But Chris, do you have any other colour from the London market?
Yeah, sure. I mean, I'm a big fan of parametrics when they add value to the customer, right? I'm less of a fan of people that say it's a parametric product when it doesn't really have many benefits to the customer by being a parametric product, but it sounds innovative. But in the reputational harm space, absolutely parametrics is a great approach because it solves a real issue where it's hard sometimes to look at maybe, your trigger is your stock price, or your trigger is, the amount of investment you've got, or the amount of users that are going onto your website, or the amount of people that are using your product. It's tough sometimes to weed out an event that has caused a dip versus just something that's cyclical in nature. Maybe it's seasonal, your business model, or something that's the whole market has been affected. So I think actually using parametric triggers in this space is really useful. But it can only be done really in a collaboration with those clients. I don't think you can build, in many cases, an off-the-shelf product that's going to work for every platform, because every platform's slightly different in the way they engage their user base. And so what you will need to do is sit down with those platforms and say, right, okay, these are the shifts you had in whatever metric you decide is the right metric for your company. So typically what you report on growth targets, etc. You look at your trajectory and then you start saying, okay, where's the tolerance level where you want to buy insurance versus this is just a business type risk? And then saying, right, what are the events that we can think of that could potentially trigger that, and having it maybe on a name peril basis. So where you'd say if it's something bad comes out about one of your investors, or something on the board happens, or there's a disaster scenario that affects your business, and then the insurance kicks in after a certain dip in one of those metrics. So I think they've got to be really carefully designed. It's very much a partnership model. Probably the products that are in the market today are going to be for your more sophisticated buyer by nature. And so back to Olly's biggest frustration, I think it would be if a startup was worried about a reputational risk product, that might be a lot more difficult product to buy. And that's probably where the biggest source of innovation needs to happen around reputational risk.
Maybe a quick follow-up question on parametric, because I think that basis risk is something that people have known of for quite some time. But there's a question when it comes to parametric: is it a fair trade-off to say that rapid deployment, so very quick settlement of the would-be claim that is not going to add up to the total indemnity for loss, but just trading off, saying getting some funds in order to address what is a problem, to do that is more important than to be 100% compensated for the provable loss? Do you think that's something that is fundamentally fair, and leaving aside some of the regulatory issues for a moment?
Yeah, I think if I were to comment from a kind of startup, small business perspective, for me, I guess, is it valuable? And is it valuable rather than is it kind of fair? I think it's all about again, context and the business. And for me, it's pretty much just about cash flow. So again, difference maybe between a tech startup and a small business. If it's a small business, normally cash flow is the thing that's going to kill them. And so if I get 70, 50, 30% payout within, a month, massively valuable, because if I have to wait 6 months to get paid out, I probably won't exist. So I'm kind of bricks and mortar businesses for sure, small businesses that are very sensitive on cash flow. I think it's massively valuable. For tech startups, maybe less so, where they're either more, less kind of cash flow sensitive, because they're either well funded and well capitalized. And so actually it's more about demonstrating, I guess, maybe even return to investors. But yeah, I guess I'd link it so closely to cash flow.
Yeah, thank you. That's really helpful nuance. I'll see, are there any more questions maybe from the audience, given another opportunity to those who are dialing in? We have an interesting comment from the audience indicating that the narrative on parametric ought to be parametric and indemnity rather than one versus the other. Maybe we can comment on that a little bit. I tend to agree. I don't think that many things are intended to replace others, like the sharing economy and bricks and mortar companies. I think will continue to exist side by side. And as you mentioned, Olly, there's a lot of context to address when it comes to discussing parametric. But if anyone has any closing thoughts on the comment from the audience.
It's a fair comment.
I think that's a good. I think it's a fair comment too. To the point about, I think there are some liquidity advantages that you've mentioned and Olly's mentioned about having a parametric product. I think that probably is more relevant for certain types of risks than others. So I can imagine that you really want to get remediated if you've got a big, an IT outage or a cyber risk where it's going to be potentially existential. But I think the point's well taken in the sense I'm not sure that the parametric is necessarily a substitute for indemnity type products. It can fill in the gaps, I think, potentially around what are existing insurance policies. One of the things that came out from discussions when I was speaking to insurers was, well, we have a fundamentally flexible product already, particularly in the liability space. General liability product, it can all be flexed, right? If you have endorsements or extensions, it can all be. But fundamentally, when you have a product that's still based on legal type terms and insurable interest, I think there is a role for having some product that provides compensation quickly and efficiently to supplement some of those covers. So I don't think it's an either or. It's definitely a complementary.
And it's worth perhaps on a related point, remembering that many of the, maybe not so much the platform itself, but the users of the platform, the customers, I think would find something like parametric incredibly attractive because the biggest benefit is that it's very simple to understand. So there's no complexity about how much you're going to receive and whether you're covered. It's very clear this is the trigger and this is how much you receive. So I think there's also a very big benefit to the users of the platform, whether our users or providers. I think parametric has a big part to play there.
And not necessarily parametrics, but we've done obviously a lot of work in the sharing economy. And one of the challenges we had quite some time ago was, a platform looking to host leases of accommodation and commercial properties wanted to provide an insurance product where if there was property damage, that they would recuperate that property damage or compensate the host, the owner of that property, for that property damage. Now, we could have gone down the angle of offering a straight up insurance policy, which would have been wrapped with huge amounts of legal jargon and huge amounts of regulation. But actually, it was better to position it as a guarantee, so not actually insurance product. So what you actually say is we guarantee that if there's any property damage during this rental, we will recuperate you with its own terms and conditions, but not necessarily an insurance contract. And then all you have to do is position an insurance product behind that guarantee, which most insurers will call a CLIP, which stands for contractual liability insurance product. So you're basically insuring the cost of that guarantee. And it makes it a very simple product. It obviously works well for property damage rather than bodily injury because it's a lot less complex, especially when it's non-natural catastrophe related, right? You're talking about small interior damages, not your huge complex property type claims. So there are other ways, I think, that we can just tweak our product slightly in the way that it's distributed to actually make it a lot better for consumers, a lot better for platforms. But that just takes a mindset where you can listen to a problem, be willing to challenge the status quo, and like I say, partner on a new type of solution.
And that reminds me actually of another aspect of the parametric insurance that came out in the context of the report, which is that some of the parametric triggers might well be more amenable when it's not related to harm or damage, but maybe just the failure to perform. So there's a good example in the report that we gave a box on about the sort of guarantees that you might well want for artificial intelligence software. You're not kind of indemnifying or providing compensation against any physical or financial harm that might come to the client, but you're just trying to provide some guarantee that the performance is credible. So in that way, it provides a marketing boost to a digital entrepreneur who can market his software as being road tested and calibrated with the help of the risk engineers of an insurer. So that's another angle where performance is the key in terms of making your business viable.
Those are all good points. And I think just to close up the remarks and the Q&A, that the Geneva Association report has given us a lot of paths. All of our panelists have given us areas that we can go back and where we can tweak, where we can innovate from scratch, how we can better serve the consumers, platforms, digital entrepreneurs, intrapreneurs alike. So with that, Darren, I'll turn it back over to you for closing remarks. And thank you to the panelists for all the very...
Thank you, Gisele. When I had this webinar, I thought I wouldn't learn any more than I'd found out through the report. Indeed, because I'd be speaking to both Olly and Chris and also Carl in the context of doing the background research. But actually, I've learned quite a lot through the webinar itself that I would hope to have maybe included in a report, maybe the next report we do on the topic. I'm sure it's one that's going to last. I mean, at the beginning of the report, when I was doing it, it seemed like a pretty esoteric type of topic. And actually, the more and more I got into it, the more interesting it became. And I'm sure it will be something that has a more legs to the debate. Just leaves me to do two things. One is thank all the panelists, including Gisele for chairing it, but also Olly, Carl and Chris for participating. I think it's been a great conversation. I've really enjoyed it. And finally, my comms colleagues will berate me if I don't, but we need to highlight the fact that we'll have a feedback form to circulate to the audience participants in the webinar. You might think of that as a sort of admin thing that we just go through the motions. Actually, we don't. We look at them quite carefully each time to see how we can better target some of both our research, but also the way that we're disseminating it and the outreach activities we do. So really, really appreciate it if people could take the time to fill out that form. It's really helpful for us in improving our outputs. With that, I think I can close the meeting. We're a couple of minutes early, but it's been really great conversation and I hope everybody's enjoyed it.
Thank you.
Yeah, thank you.
Everyone.
Thank you.
Bye.
Thanks,
Bye.
everyone.
Bye.